Welcome to the Stock Option Assassins free trade of the week. My name is Eric and today is Thursday, February 19th, 2015. And in this week's edition of Trade of the Week, we're going to look at a trade we put on today actually with our members in Goldman Sachs. If you haven't done so already, be sure to subscribe to our YouTube channel for more technical analysis videos and strategies. So let's go ahead and take a quick look at the XLF. This is the financial ETF, and then we'll get into our trade. So, recently, obviously, stocks have been kind of correcting, and we've kind of broken some trend lines and things, and it looks like we're kind of breaking out, at least on the indexes. But if we look at just the financials in general, you can see we were in this downtrend. We broke the downtrend, kind of cleared this previous high, and we're kind of sitting at this previous resistance level on the XLF, which is about 24.5. That's become resistance, and you can see we've kind of come up in there. We're pulling back a little bit, and so we're in the context of a sort of a short-term uptrend. For my overbought and oversold indicators, I like the DMI oscillator, DMI stochastic extreme. The DMI stochastic extreme is what I really like for sort of entry, sometimes exit techniques, but basically we're pulling back a little bit here, and we're very oversold. And so I start looking at, well, what names can we get into on the long side in financials? And Goldman Sachs came up. We talked about this with our members yesterday, and we actually put this trade on earlier this afternoon. And you can see that Goldman Sachs kind of mimics the XLF, and the fact that it's in a downtrend, it's broken up, and now it's starting to consolidate here. This is a nice bull flag. I like Goldman Sachs. The options are very liquid, so this is a great spread selling candidate, and that's what we did today. We sold the 185, 180 March put credit spread, where we sold the 185 put. That's the red line, and we bought the 180 for protection. We got a credit of about $1.15. And so one of the questions I get a lot is, why wouldn't you just buy calls? And you can buy calls. The problem with that is that the market is still kind of, it seems like it wants to break out. You still have a lot of headline risk out there with Greece and Russia and all these things. And, I like the consolidation here. We're in a pretty good time frame. Typically, when you have less than 30 days left to expiration, which as of today, there are 29 days left to March expiration, theta is really going to kick in. And our goal here is to sell these two options, or sell this spread, sell the 185 by the 180 for a credit, and for the market, in this case, to Goldman Sachs, to move up, and these slowly become worthless. So again, we're very oversold. For me to buy calls, I would typically wait for a buy signal, meaning we get oversold and then we tick back up. But when you sell a spread, we can actually pull back a little bit further. And the idea is that it's a little bit more forgiving if you're short-term wrong. You're not worried about getting stopped out right away if you put a stop on here. And 185 actually, and I don't have it on this chart, this purple line is the 13 EMA, but 185 is actually slightly below the 50-day moving averages, so this spread sort of fits with any other moving averages you may use. So that's our trade of the week. We have the March 185, 180 put spread, and we're looking for Goldman Sachs to hold above 185 over the next 2 to 3 weeks. That's it for this video, and I'll see you at the next update.